Credit crisis coming. The sky is falling. Market crash looming. These are the headlines that we're seeing right now. Folks, take a deep breath. This is the same thing that I told you last week. We had a nasty Friday the week before, and it looked like the market was going to continue to sell off. But I told you in that video, we might see a little bit of follow through, but everything is not going to go to hell in a handbasket overnight. And I'm going to explain why. Before I do that, I'd like to ask you to please subscribe to my YouTube channel and to give the video a thumbs up if this content is helping you. And YouTube came out with a really cool feature I'm hoping you'll be able to use as well. It's called their hype button. So if you're watching this on your mobile phone and you're using the YouTube app, right under their logo, you'll see this icon. Please click it and click hype, and you'll help me reach even more traders. We've had a fair amount of volatility during the course of the last week. What's driving all the action? Well, we did have some bank earnings this week, and they weighed on the market. They took big write-downs, and the tricolor write-down was one of the problems. Zions Bank had some other write-downs that they took. Initially, when the earnings announcements came out, they were pretty well received. And we can see that in the XLF. When JP Morgan announced and Citigroup, we actually had a pretty nice little rally going, and the XLF was able to rally off of the 100-day moving average after those earnings announcements. Looked like all systems go. On Wednesday, we're actually above the 50-day moving average. And then wham, on Thursday, as soon as Zions Bank announced its earnings and a $50 million write-down, all the regional banks started to sell off. And then Jamie Dimon came out and he said, where there's one cockroach, there's usually more. Everyone got really worried. We did also have the banks tap the Fed's repo window to the tune of about $14 billion. That's a big number. And that is usually a sign that there could be some liquidity issues. So yes, on Thursday, we saw a pretty decent market sell-off, but things bounced right back on Friday. Another bullet dodge. The one thing that I can tell you about credit is that this is a house of cards. We all know it's a house of cards. It spans the entire credit spectrum. You can go to consumers and you can look at credit card delinquencies and defaults. Yes, they are rising. You can look at municipalities. You can look at states that are running huge deficits. Look at our national debt. We have a government that can't even agree on a continuing resolution. The longer this lasts, the worse it'll be. Yes, this could get resolved in a few days, but it might take a few weeks. And if it takes a few weeks, then our credit rating is going to suffer as a result. It's an issue. It's a festering issue. I've been through this in 2008 and 2009, and I can tell you that every time that it looks like the market's going to fall apart because there's some kind of credit issue, it finds its footing. And the reason is because the Fed is going to come out and they're going to cut interest rates. The Fed could get into quantitative easing. They could come out with bailouts. There are a number of tools that they have available to prop the market up. You don't need to look any further than Silicon Valley Bank. Oh my God, here's a regional bank that just went under. Look at how far the market has rallied since then. Now, I don't want to completely discount the credit issue. And by the way, it's not just the US, it's everywhere. France is having issues. Their political parties are in turmoil too. They can't get anything passed. They can't get any austerity programs passed right now. And their bond yields are starting to spike as a result. Look at Japan. Japan said, we're in worse shape now than Greece was in 2011. Holy cow. That's a heck of a statement. China is absolutely falling apart, and their municipal workers haven't been paid in many months. So we have issues everywhere, and it is a house of cards, and there are dominoes, but we have to wait for those dominoes to start falling. Banks are a great way to watch what's happening in the credit market. So if you start to see XLF continue to sell off and continue to sell off, that's not going to be a good sign. But as long as XLF starts to find its footing and it stays around that 100-day moving average, everything is going to be just fine. So let's take a look at our prior pick. This came out last week, and if you recall, we had a gigantic market sell-off. We had a long red candle. And so when I did the video on Sunday, I was trying to find a stock that I would like to own. I suspected that the market was going to sell off Monday, maybe Tuesday, because that's been the pattern. After a big drop like this, we usually see some follow-through selling. Didn't happen. Going to get into market analysis in just a bit, but I still like the PATH trade, and we were able to sell the 1550 puts, October 31st expiration date. That's what I had recommended in the video, and we were able to get, I believe it was 60 or 70 cents that we're trying to get for those puts. So our net cost, if we're assigned on the stock, is somewhere around the $14.80 level. So down here around this red line right here, which is AVWAP-E. I love the fact that the stock has been able to rally and break out through this horizontal resistance. I love the fact that we had lots and lots of volume coming into the stock. That tells me that long-term investors are interested in accumulating the stock, but I didn't want to buy it all the dang way up here, especially when there was a chance that the market might continue to pull back. So yes, the stock has pulled back a little bit. I'm not worried about it. I'm ready to take assignment on it. I like this rally. I like this volume. I like buying it near that breakout. That would be my starter position. And so if we look at where the stock is right now, it closed at $15.44. We're still above what our net cost would be if we get assigned, and we've got a couple weeks left on this trade. So I still like PATH. Let's get on with some market analysis. So the news last week was fairly light. We had no economic news to really speak of because the government is shut down, so we aren't getting any data points, which that's a problem in and of itself because we don't know what the job scene is. We don't know what the inflation scene is like. There's really nothing for us to latch onto. So we're kind of doing this zombie march, wondering what the economic growth rates are currently. We did have earnings announcements, and we did actually have an economic release, and that was the Beige Book. The Fed looked at it. They said, economic conditions across the nation seem very stable right now, so they weren't overly concerned with what they saw there. It's backwards looking, though. So keep that in mind. But yeah, the Beige Book looked pretty decent. The big news that we had was earnings. And so we had banks announcing earnings. As I mentioned earlier, they came out, they were favorable initially, and then wham, they got hit pretty hard. And during that sell-off, we also saw a spike in VXX, which showed option implied volatility is increasing. The one thing that can always ruin a nice market rally is a credit issue. But again, it's going to take a long time for that to fester and fester, and the Fed is going to do everything in its power to minimize its impact and to calm investor nerves. Don't worry too much about banks and credit issues. We also have some seasonal strength coming up in about another week or so. Asset managers like to buy the market into year end because it makes everybody feel good. Their assets under management grow and they make bigger bonuses. So there's an incentive for them to buy into year end. So as far as the news last week, the earnings announcements that came out, banks were an issue. TSM came out, Taiwan Semiconductor, and that stock actually reported a 39% increase in profits year over year. Wow. Awesome. Great number. Stock should be off to the races, right? It opened higher. It opened at a new all-time high, and then this long red candle. Okay, now you could say that was related to the market decline that we saw and the whole banking issue. Yes, but if that were true, today when the market was up, you can see how the stock continued to sell off. So maybe tech stocks are a little bit tired up here. That would be my takeaway, but we've got a lot of earnings announcements coming up. So let's take a look at the companies that are going to be announcing. Now, I ran a search in Option Stalker, and I was looking for stocks with very liquid options. So this is not an all-inclusive list, and they're going to be reporting within the next 10 days or so. Tech stocks have been leading the market rally, so let's pay the most attention to them. And here we can see going down the list, we've got GLW, that's been a really strong stock, IBM, Intel, LRCX. Those are your big tech names. Netflix will be important. And as we go down the list, we'll see Tesla and Texas Instruments. Those are the major companies that are going to be announcing in the next 10 days. And then just beyond that, we've got Apple and Google and Microsoft. All the big names are going to be reporting within the next 2 weeks. And we also have an FOMC statement coming up on October 29th. So that's about 10 days out. So we do have a lot of news coming up, but the government shutdown is kind of keeping us from seeing what's happening day to day. So as far as any kind of news coming up this week, it's really going to be focused on the earnings announcements. And at the end of the month, we're going to have trade talks with China, if they even happen. And yes, that is news that's currently driving the market. There are concerns that our relationship with China is deteriorating. And Trump has also announced that I believe the first week in November, they're going to be imposing 100% tariffs on China if they continue to restrict rare earth shipments. There are a lot of moving parts going on right now. We don't need to follow the headlines, we follow price. Let's do some technical analysis and get our bearings. So here's what the technicals look like. This is the large sell-off that we had a week ago Friday, and you can see how the market closed just above the 50-day moving average. As I'd mentioned last week, typically when you have these long red candles off of an all-time high, you're going to get some follow-through selling. Well, we came in Monday morning, and what happened? Oh my gosh, we had a 60-point overnight rally. Well, right off the bat, that tells you that buyers were aggressive. And I had mentioned this in my Sunday video. It came out way before the market even opened overnight. So I had no idea what was going to be happening. I only knew that if we did get some type of follow-through selling, that it would probably happen Monday and Tuesday, but that we were going to bounce. How did I know that? Because the market has been so flippin' strong. These little dips have been brief and shallow, and that tells us that buyers have been super aggressive. They are in control. Bull markets die hard. Never forget that. This market's been in a 100-year uptrend. Hardly anything can spoil that. Credit issues can spoil that, but they take a long time to manifest. And again, remember that as they start to happen, there is going to be time to adjust your risk because the Fed is going to pull out all the stops to calm investor nerves. There'll be bailouts and rate cuts and quantitative easing and everything else. So bear that in mind. But yes, credit, especially credit around the world, can have a domino effect. So we've got to keep an eye on this, and I certainly am very vigilant. I'm always watching for this. But what happened this week? Well, we can see, and this line right here, this green line, is a VWAP-Q. So this is a volume-weighted anchored VWAP, and I anchor it to triple witching. So the Monday after triple witching is where we start calculating a VWAP-Q. And you can see how the market has been testing it with these wicks. Look where it closed today, right at that level. And if I edit this, I'm going to add one standard deviation above and below it. And you can see how the market has been within this band the entire week. We don't have any sense of direction right now. Buyers and sellers are paired off. If we go into the 30-minute chart, we can see, look at this. You've got long red candles followed by long green candles, followed by long red candles. Nobody has control in here. Up and down, up and down. And we're still within last Friday's range. You can see there is a wedge formation. So let's connect these highs. Let's connect these lows. That's a wedge formation. We need to, at minimum, break out one way or the other, but I really wouldn't even trust that. We need to get below the low from Friday, which is also the 50-day moving average, or we need to get above the high from Friday, which is an all-time high. One way or the other, we've got to get out of this range. Otherwise, everything is noise. And if the volume is light, it's all going to be program-generated chop, just random back and forth movement. Well, that makes trading conditions very, very tough. And I don't know which way the market's going to break. And there are a lot of different issues that are currently in play. What happens if the shutdown continues for another 2 or 3 weeks? Well, at some point, investors are going to get nervous and the market is going to send politicians a signal, and we're going to see a big drop if this continues to loom. What's that time frame? Is that another week from now? Is it 2 weeks from now? Is it 3 weeks from now? I don't know. Certainly, I think if this goes on for more than a couple of weeks, it's not going to be good. But what if they come out and sign the continuing resolution? Well, then we're probably going to see a big market rally. Either one of these could play out. I don't know which one it's going to be. So that means that we could have a big move higher or a big move lower. We've got the whole China tariff thing. How is that going to go? I don't know. I do know that China is currently flexing its muscles. They feel that they have some real leverage with rare earths. And I'd mentioned it in last week's video. So to start mining and refining rare earth minerals, it takes 5 to 10 years. Right now, they control 95% of the world's supply. Yeah, it's an issue. These magnets are used in everything. All technology requires these. So it's a big deal, and it could eventually lead to supply disruptions. But companies currently have inventory, so it's not an immediate threat. And we might as well wait to see what the heck happens with the trade talks, because they could come out just like they did back in here. Boom, we're going to remove the tariffs from China. We're going to have trade conversations. We like China. Xi is my friend. Whoosh, the market runs higher. Okay, that's certainly one scenario that could play out. And if it does, you're going to see the market rally up to the all-time high. We could also hear, that's it. We're done with China. We're not playing any more games with you guys. And then the market would sell off on that news. So again, this is a really difficult time to trade. And I'm a bit perplexed at what I'm going to be doing with this week's recommended trade. We've got increased volatility. We had VIX spiking, which let's take a quick look at what VIX did. I use VXX because everyone has those quotes, and you can see how it spiked and then pulled back. But that was a pretty big climb that we had Thursday with the bank sell-off. We've got higher option implied volatilities, which would be good because we can sell out of the money premium and we can distance ourselves from the action as we've been doing. But there's a big breakout that could be looming, a breakdown below that 50-day moving average or a breakout above the all-time high. We don't know which way it's going to go. We also have an issue with selling naked puts right now because we've got a lot of earnings coming up. And in the course of the next 2-3 weeks, we're going to have a ton of them. We're always trying to make sure that those put sales don't span the earnings announcement. We don't want that risk. So the puts have to expire before the earnings announcement, and we've got a ton of them everywhere. So there are landmines everywhere that we're trying to navigate. And it doesn't matter that the company that we sell puts on doesn't announce for 3 or 4 weeks. If there are companies within the group that are announcing in the next week or two, it's going to be an issue for us because it's going to impact that stock. Really, really tough situation. We have buyers and sellers paired off. So what does all this mean? How do we trade this? Well, the one thing that we have to do, and I just showed you that 30-minute chart, this is a time to lay low. Do not place any big bets right now. Keep your trading to an absolute minimum. Very, very low probability environment. This market could go either way. It's very news driven. And I've already told you all the stuff coming up, FOMC statement, China trade talks, government shutdown, earnings releases, on and on and on. So let's wait and see. Let the dust settle. Let's get some clarity. Once we have some clarity, and I really don't care which way it is, up or down, just give me some clarity. Now, heading into year end, if we did get a nice deep sell-off on some news, I'd probably be inclined on support to at least buy on that support looking for a year-end rally. So I'm less concerned about a huge market decline right now. Let's wait and see. And as I went through my searches and I looked for stocks, here's what I was looking for. Give me a stock that's relatively safe. Okay, I don't want it to be vulnerable to trade talks. I'd like to have a stock that has recently announced earnings, something with lower option implied volatilities. And I found a stock that fits the bill in green royal flush. You know, this is one of my favorite searches to use. It means that the stock has relative strength across all time frames. It also means that the stock has a buy signal from our trading signals across all time frame. JNJ certainly has that. And looky there. Hey, we had an earnings announcement, and we had that earnings announcement this week on Tuesday. Now, the stock pulled back a little bit on that earnings announcement, but let's zoom in, because what day would be the greatest interest to us? Thursday. Thursday's going to be of greatest interest to us. Why? Because this was the day that the market sold off. Right here, you can see that big decline. And look what the stock did. It finished up on the day. The red line, by the way, is AVWAP-E, and I measure that from the earnings announcement date. So let's take a look at the market on Thursday. Big sell-off. What did JNJ do on Thursday? It had a really nice rally. Okay, given that the market was down, here's what the stock did. Stock put in a really nice day. So, whoops, excuse me, I'm on the wrong day. But you can see the stock didn't sell off at all. It finished well and it rallied on Fridays. I like the D1 chart. I like the fact that the stock has been able to tread water when the market's been selling off. You know that from last Friday, when the market sold off hard, what did J&J do? Now, it was coming into earnings, but you could have seen some nervous jitters. Not at all. Stock was very, very stable. And this is kind of a flight to safety stock. So if the market really did have a soft patch, and if it did sell off, J&J sells medical supplies and Band-Aids. So they've got a stable business model. It's not going to have a big, gigantic drop. So how do we approach something like this? We've just had the earnings announcement. If I take a look at the option implied volatilities, you can see that it's currently at a 0.25 option implied volatility. That tells me that options are cheap. And you can see that the stock finished today at $193.22. So what I'd like to do is I'd like to buy some premium in this case because the options are relatively cheap. So we're going to go into our option chain. We're going to take a look at J&J. We're going to give the trade lots of time to work out. So we'll go out to the November options cycle, and we'll take a look at what those prices might be. And by the way, this is the November 21st. That is normal options expiration. And we're going to take a look at buying the 190 calls, and we're going to look at selling the 195 calls. This is a call debit spread. Okay, so in this particular instance, you can see that the 190 calls are already in the money by $3.22. So what do we want the stock to do? We just want it to edge higher. And if I take a look at this spread, you can see that the spread is $2.65 bid, offered at $3.15. $3.15 is the ask. Wait a minute here. The options are $3.22 in the money. That's right. We can do this debit spread, and we're basically paying parity for this debit spread. It's already in the money by $3.22. At most, we're paying $3.15. Yes, try and work the order. See if you can get in for $3.10, $3.05. What would I be looking to make on a spread like this? Well, we want the stock to just float higher. What happens if the stock doesn't go anywhere? What happens if it just sits right here for the next month? Well, that's okay too. Okay, we're not going to make or lose money on it. We feel that the stock is going to move higher because it's shown some strength when the market has been very weak. So if it gradually grinds higher and gets above 195 strike price, this spread is going to widen out. It's not going to be worth $3.10. Maybe it's worth $3.60. Maybe it's worth $3.80. In any event, let's say that we can make 70 cents on this spread. That's a 20% return. Hallelujah. I'll take that all day long. This is a really nice trade to do. I like it. I think it fits well within the context of a year-end market rally. I think it fits well within the context of, hey, the market could go through a rough patch. We could see a market decline. If we get that market decline, I think the stock is going to benefit from a flight to safety. We also know that the earnings have been well received because we've been able to watch this price action. What would I do if the market really sells off hard? Well, I'd be watching for relative strength in Johnson & Johnson. I want to make sure that on a D1 basis, the stock retains its strength. If the stock starts to lose its relative strength, if the stock starts to drop below EV/WAPQ and this support level right here and the market sell-off starts to get really ugly, then yes, we need to adjust the trade. We need to exit. We need to take our profits on it. But I don't see that happening. I feel very confident that if the stock pulls back just a little bit, it's going to find support right here at the bottom of this compression. This is a trade that I like. Again, the reason for getting out of the trade would be if it loses its relative strength. And right here, if the market takes out that 50-day moving average, this stock is probably going to hold up really well, okay? But the point here is that I got the market wrong, so to speak, and the market is breaking down. And the stock is retaining its relative strength, but eventually all stocks will sell off with the market. By being in a stock like this, we have time to adjust our risk. We have cushion, and that's the beauty of trading relative strength. If we see the market fall below that 50-day moving average and close below it and close below the close from last Friday, then we need to take the position off, take a small loss on it, move on, adjust our thinking. And in fact, I don't see a small loss on this stock as being an issue because if we do break down below this support, that's going to open up all sorts of other trading opportunities for us. Not a big issue. And if the stock happens to rally and the market happens to get through the all-time high, you're going to be able to hold out for more than 20% on this spread. And you have the potential, if you buy it around $3 and you sell it for $2 more, you sell it for $5, you're going to have a whopping gain on that trade. I like it. Johnson & Johnson is your pick for this week. The main point to all of this is that the market is in a really tough spot right now. It's very news driven. This is a warning shot right here. There are a lot of issues looming. Tread very cautiously, even to the point of not trading. And personally, I'm reducing my swing trades. I've had a lot of my put positions expire Friday. That was really nice. So my risk is automatically reduced. I still have some that are going to be expiring next week and October 31st. Those positions are all in decent shape right now, but I'm not adding to those positions because I want to see what plays out. And I'm focusing more on day trading. And even on a day trading basis, it's been a little bit tough this week because we've just got this random choppy price movement within this really big range. So this is all program driven type of trading. And the stocks that we were leaning on, the AI stocks, the rare earth stocks, all those really hot stocks that were running and breaking out on heavy volume, they've subsided. So we haven't seen that type of action there. But it was kind of nice because we were able to ride some of those stocks and day trade them actively and make some really nice returns. So that game has kind of ended for us right now. We're in a holding period. This is a time to keep your risk low, not to place any big bets. Tread cautiously, wait for clarity, wait for these opportunities to open up, and look for situations like J&J. I think that's going to be a nice little trade for us. Thanks so much for watching. We'll see you soon. See how we trade live every day and take our 14-day free trial. I won't even ask you for a credit card. Dive into the action and trade alongside of us. Your downside is that you get some great trade ideas. Your upside is unlimited because you'll learn the skills that you need to be profitable. Check out OneOption.com and see for yourself.